This would be our third video discussion for past 2 for inventories. So if you're watching this video already, make sure that you have watched the first 2 videos and make sure you have absorbed the items that are excluded from the scope of past 2, the types of inventories that are not governed by past 2, namely your financial instruments held for sale, your biological assets, and your agricultural produce. And please remember also the type of inventories that are exempted from the measurement provisions of past 2, because in their industry it is established that they are to be measured at net realizable value and not at lower of cost or NRV, which is the measurement rule for past 2, which we will discuss later on. Also, it's important that you can remember already the components of our net realizable value or our NRV. Again, your net realizable value is equal to your estimated selling cost minus cost of completion and minus cost to sell. So moving on, we would start our discussion with the measurement rule provided in past 2. So past 2 requires class that inventories shall be measured at the lower of cost and the net realizable value. Now, this provision alone class is interesting because unlike other standards, which you will learn later on, past 2 does not provide a separate rule for the initial measurement and subsequent measurement. Other standards class would provide that upon initial recognition, that during the first time an asset or liability is recognized, it is going to be measured in this particular manner. And at the same time, it would also provide a separate provision on how it is going to be measured subsequently, how it is going to be measured for subsequent periods. So some standards give you a different measurement rule for initial measurement and subsequent measurement. But interestingly, class, past 2 does not provide separate rule for initial measurement and subsequent measurement. But this is not to be understood, class, that the fact that past 2 contains a singular provision for measurement means that the initial measurement and subsequent measurement for inventories would be the same. It is well settled that the initial measurement of your inventories class would be at cost. You record your inventories upon initial recognition at the amount of cost it took for you to acquire the asset. And it should make sense, class, because if the standard tells us that the measurement for inventories is to be at the lower of cost and net realizable value, if you do not initially recognize it at cost, then you will not have any cost to compare it with the subsequent net realizable value in the next reporting periods. So you start with cost first, and then for every reporting period thereafter, measure or report your inventories at the lower between the cost and the net realizable value. Every subsequent reporting period class, you will have to compare the original cost of the asset and its net realizable value at the date of the financial statements. Whichever is lower between the two, that would be the amount that will be used as the carrying amount of the inventory in the financial statements. So if the original cost was 100,000 class and this year the net realizable value is 80,000, then you will have to bring down your asset in the amount of 80,000. If again the original cost was 100,000 but the net realizable value this year is 120,000, again you choose the lower amount. So in this case, the cost is the lower amount, so you just continue recognizing it in the amount of 100,000. And because we initially recognize it at cost class, it will never happen that we will have to recognize an unrealized gain in case the NRV is higher. So for example, the NRV is 120,000. We do not change the carrying amount of the inventory to 120 because if we do so, we are in effect recognizing in advance the potential gain if we were to sell the inventory in the amount of 20,000. By virtue of conservatism class, we do not recognize in advance such potential gain or income. And that is why the measurement for inventories would be the lower between the cost and the net realizable value. So, to make it clear, class, if you will be asked at what amount should inventories be initially recognized, at what amount should inventories be initially measured, your answer would only be it is measured at cost. But how are inventories subsequently measured? How are inventories going to be reported in subsequent financial statements? Our answer would be it is to be measured at the lower of cost and net realizable value. Upon initial recognition, just use the cost. For every subsequent reporting period class, you will have to keep on choosing between the cost and the NRV. And the rule is to simply choose the lower amount. If the cost is the lower amount, no problem. No need to change anything. We should not recognize the potential gain in advance. But if it is the net realizable that is lower class, since our records originally carry the inventory at cost, then we will have to bring down our inventory to its net realizable value. And to do that, you will have to reduce the previous carrying amount of your inventory. And in such manner, class, you will have to recognize a loss on inventory write-down. We will expound later on loss on inventory write-down. So if you'll notice, class, if you'll recall our discussion on prudence during the conceptual framework discussion, we are more inclined to recognize a loss on the decrease in the value of our inventory rather than recognizing in advance the potential gain from the increased value of our inventory. But again, the important point here, class, is that you can recall how inventories are to be measured. Initially, inventories are to be measured at cost, while it is to be subsequently measured at the lower between the cost and NRV. The mnemonic for the subsequent measurement rule for inventories class is LCNRV, lower of cost and net realizable value, LCNRV. As another note, class, by initially recognizing inventories at cost class and not at LCNRV, we are able to avoid the scenario in which we will be forced to recognize a loss upon initial recognition. You have just bought your inventory class. Because of the decline in the prices of the inventory class, your expected net realizable value is low. Then you will be forced to recognize a loss even though you have just purchased the inventory. And that would not be ideal. However, there are accounts class that would allow for the recognition of a loss class even on initial recognition. We will discuss that later when we discuss PAS 41. But again, the important thing to remember here for PAS 2 is that inventories are to be initially measured at cost and to be subsequently measured at the lower of cost and the net realizable value.